All right, it's 3 o'clock. I'm going to call the meeting to order. I'd like to begin with the roll of committee members. Deborah Doyle,
Here.
David Cahill,
Here.
Barbara McKenzie.
Here.
All right, we're all here. Also in the meeting, we have our CFO, Myrna Lopez, our new deputy director, Dara Brads, and our very new accounting manager, Catherine Line. Great to have you all here. All right, announcements. There are non-public appearances. Do we have any letters from the public, Lisa?
There were no letters received for public comment, and I'm just going to double check our participants. We do have some members of the public in attendance. But in item 3, you can ask if anybody has any
All right, so
comments.
do we have any, that's where I thought I was, I'm sorry.
Oh.
So do we have any public comments?
Are there any members attending via Zoom that would like to make a comment? This is your chance.
Okay, I'm hearing none. We're going to go to discussion items. First is 4.1, the draft audit for the fiscal year ending June 30. We have Kellen Gilbert from Pacenti and Brinker joining us virtually. Myrna, were you or Kellen going to make any review of the audit before we open it up for questions?
Yes.
Kellen has a presentation as he has done in the past. This is our annual audit for our financial statements ending fiscal year June 30th, 2023. And happy to be at this juncture on a timely basis. And I do want to thank staff of the county accounting services group who helps prepare the financial statements and provide support throughout the year to ensure that we're in compliance with our own policies and procedures and those government accounting principles. And also our own internal staff day-to-day work very hard to stay on top of all of our tasks. So I want to thank them, and I want to thank Kellen for being here today and completing this required audit that per our JPA, we required an annual audit.
Great, well, thank you. And Kellen, welcome. We're going to turn it over to you.
Can everybody see me and hear me okay?
We can hear you. We can't see you.
Okay, I'm not sure how to change that option. I also don't have the option to share my screen at the moment.
All right, Lisa is working on that for you.
And worst comes to worst, she has a copy of my presentation and she could share that if we need to.
I'll just go ahead and share your presentation because I'm not seeing an option to allow you to share.
That works for me.
Sorry, we can't see you, but we do appreciate you being here. And I'll just remind those in attendance that you have led the team at Pacenti and Brinker that's been responsible for the audit for the last few years. So you know us well, and we're grateful to you and your team for your timely work. It's all to you. Can you see what Lisa is sharing with us?
Unfortunately I cannot. I was able to see the agenda earlier, but now I'm just seeing the full room. There we go. It's bringing it up. Okay. Great.
Right,
and if you could switch it to the, thank you. The next slide is just a brief introduction of the team, myself and Brett Bradford, who is the independent quality control report reviewer. Alyssa Foster was the audit senior on the engagement for the second year in a row. And Andrew Deering was the audit associate who assisted us during the audit. Next slide, please. Okay, I always like to start with this slide. I think this is a great slide to talk about, as there's always just a little bit of confusion over the exact roles and responsibilities of each party. So management, and in this case, that includes the auditor, controller, treasurer, tax collector at the county. You're responsible for the preparation of the financial statements. That includes all the footnotes, all the related underlying related financial transactions, all of that information contained in the financial statements. That is the responsibility of management. And you're also required to maintain and establish and test your system of internal controls over the financial reporting processes. Our responsibility as the auditor is to provide an opinion on the financial statements of whether or not they're free of material misstatement. And really why I like to start with this slide and just to discuss more what that means in practicality is we as the auditor, we don't evaluate transactions based off of whether or not it was a smart managerial decision. We don't look at transactions for whether or not it's the best allocation between the funds when it comes to expenses, so the general fund or the Measure Y fund. We really are looking at whether or not the financial statements and the underlying transactions have been recorded appropriately in accordance with GAAP and GASB's, making sure that those accounting standards are met. We are not judging the underlying use of the transactions or evaluating management for how well they complete the goals of the library. And I think this is going to be part of a later discussion too, but we don't evaluate the adequacy of pension contributions or the amount of net pension liability that is at year end. Those are all responsibilities of management. We as the auditor only assess the financial statements to see whether or not they are free of those material misstatements. To do that, we consider a couple different things. Inherent risk, which is by definition is how complex are the underlying accounting transactions. Are there accounting transactions with lots of revenue recognition criteria, something that would take a lot of judgment for management to determine when they could record that revenue, the volume of transactions. Really, when we talk about inherent risk, we're really saying how complicated, how confusing are these transactions, or are they fairly straightforward on their face? We consider control risk, which is, again, your system of internal controls. We consider turnover of staff. We consider safeguards of accounting information, the processes for transferring financial information between the library and the county. We consider all of those things when we are coming up with what we call our risk-based approach, which is how we determine what procedures to perform and how much testing to do over a given financial statement section. Once we've completed that planning, we do test of year-end balances. We're looking for cutoff, making sure that everything that is recorded in the right period and not inappropriately falling into the last period or to the next period. We test balances for existence and completeness, making sure that everything that should be recorded is recorded. And lastly, we evaluate the adequacy of the disclosures. Next slide, please.
Kellen, I'm going to stop you for just a second. I just wanted to check with the members of the committee. Do you have any questions based on what Kellen said about the scope of the audit and what is what Picenti and Brinker is responsible for and what they're not.
No,
Okay, thanks. Please go ahead.
Great. And so this slide is just a real quick financial highlights. I think it's useful to kind of just start about where the library is currently at and where they've been. So total assets and deferred outflows exceed total liabilities and deferred inflows by 38 million. That's your net position. And I'm going to talk at length about deferred outflows and inflows later on. And that's an increase of 6.1 million approximately this year. The Measure Y fund, which is an important fund within your financial statements, increased by approximately 1.6 million and has an ending fund balance of 22.8 million. And lastly, that third bullet point, it really kind of gives you an idea of where you've come the last few years. Net position is increased by approximately 36.4 million over the last 5 fiscal years. Next slide, please. And this slide just gives you a rough idea of where we spend our time. Obviously, there's a number of other sections that are smaller in nature that we can't put an exact percentage on everything, but just to let you know kind of where we view the significant areas of the audit. Cash investments are relatively easy to audit, but because of their importance, the size and liquidity, we do spend some time there. That's about 10%. Accounts receivable and revenue recognition is always an important part of any audit. That's about 15%. The financial statements, your financial statements are on the larger size, and so it's about 20% of our time. And then accounts payable and liabilities, less so, about 10%. Pension and OPEB, the Measure Y compliance and capital assets and leases are about 15% each. Next slide, please. Okay, so
Kelly, can you hang on 1 second, please?
Yeah.
Dave?
yes, sir.
Why are our financial statements on the larger side?
Your financial statements are on the larger side just because you're a larger government entity. You've got pension and OPEB disclosures that are significant. You have multiple funds, so it's not a statement of good or bad or anything like that. It's just that your financial statements are more complex than a standard or typical local government agency.
You okay with that, Dave?
Yes, thanks.
Yeah, thanks, Kellen.
Yeah, absolutely. Yeah, please interrupt me anytime. I've worked with this committee. I love this to be just an open conversation, not just me reading off the slides. That being said, I will get back to reading on the slides. The one new accounting pronouncement that we wanted to let the committee know about is GASB number 96. We call these SPITAs, S-B-I-T-A, which stands for Subscription-Based Information Technology Arrangements. So what this standard requires is that if you have a multi-year subscription agreement that is non-cancelable, you are required to now, instead of just recording the expense in the period that it happens, the GASBs want you to put that on your statement of net position or your balance sheet as a intangible asset. So that's one change from past years. As I say in bullet point 3, this created a new financial statement line item on your statement of net position. If you'll see it, it's a very, very small amount. I think it's about $9,000. And it's called SPITA assets. You'll see that again on the statement of net position. So overall, we don't consider this to be a material transaction just due to the size of it. But I did want to let you know that it was a new accounting standard that you adopted during the year. Next slide, please. I'm sorry, next slide. Oh, thank you. Okay, so I met with Andy early in the week, and he gave me an impossible task of trying to describe what deferred inflows and outflows were on a easy to understand, common sense basis. And I will say, Andy, I spent a number of hours trying to see if I could find something online that breaks it down in an easy to digest manner. And I was unsuccessful. So I will do my best to put it into my own words while also giving you the technical definitions, and then we can kind of discuss it. But essentially, GASB number 63 and 65, the GASBs are always interested in trying to provide more information to the readers of the financial statements, or to provide more useful information to the readers. And it was their judgment that there were certain transactions that should not be recorded as assets and liabilities. They were different enough in nature that they wanted to specifically call them out as deferred outflows and deferred inflows. So deferred outflows used to be recorded as assets, and deferred inflows used to be recorded as liabilities. And when GASB 63 and 65 came out, they set a number of different types of transactions that needed to be separated and shown as those deferred inflows and outflows. So in the way I think about it is that a deferred outflow most commonly resembles a prepaid expense. It's a situation where the cash has already been paid, but it's related to an expense in a future period. And a liability typically, a deferred inflow typically arises when you have cash that's received in advance of the period in which you're going to recognize that revenue. That is usually when we have deferred inflows and outflows. Unfortunately, that's not that hard to understand, but in your case, you have deferred inflows and outflows related to pensions and OPEB costs, and those are all related back to the actuarial reports that I'm actually going to talk about in a moment. But those type of deferred inflows and outflows are much harder to explain as they relate to timing differences between past actuarial reports and then as time goes by, what's actually happened to those actuarially determined assets and liabilities of the library related to the pension and OPEB. I started all this by trying to say I was going to make it easy to understand. I feel like I failed at that, but that's my first attempt of trying to explain what the deferred inflows and deferred outflows are. If you'd go to the next slide, please. So this is the textbook definition of what is a deferred outflow. It's the current consumption of net assets by the government applicable to a future reporting period. Deferred inflow is the current acquisition of assets, government applicable to a future period. Again, that's the textbook definition. It's a little bit hard. I've been working in government auditing for 17 years, and I still have a hard time truly understanding the concept or why they felt the need to peel those away from assets and liabilities. Next slide, please. Again, that you do have two types of deferred outflows and inflows related to the pensions and OPEB. You can see what the exact breakdown is of those. They're on pages, I think, 36 and 42 of the financial statements. You have about 7.5 million and 3 million of deferred outflows related to the OPEB plan. Of the pension, so 7.5 million of the pension and 3 million of the OPEB. Most of these relate to contributions that the library has made to the plan, but that took place after the measurement date of the plan. And The measurement date and the valuation date, that's another upcoming slide and discussion. But that's what the majority of the deferred outflows relate to. So again, contribute an example and what's applicable to the library is a contribution that was made in 2023, so in your fiscal period, but is not being picked up by the actuarial calculation because those are done in arrears, and they were measured as of June 30, 2022. So they're related to 2023, but they're not being recorded by the OPEB calculation as they were made after the measurement took place.
Kellen, it's Andy. That actually seems clear. I think the naming of these items feels really unfortunate to me, but I'm getting the sense from what you're saying that deferred outflows those are like assets. We've made a contribution. It's just not reflected in the actuarial statements because they have a different date. Is that the case?
You said it very eloquently and easy to understand. Yes, for the deferred outflows, yes, those are related to payments that were made in the actual period that we're looking at, but they were not made before the measurement period took place.
Well, I think you and the folks at Vicente and Brinker should be thankful to the Gatsby folks by picking these unfortunate names. They're certainly providing additional work and job security for the continuing future. We're grateful to you. Thank you.
Well, I honestly, I would trade that security to get rid of these darn things. I can't say enough how much I dislike the Gatsby's decision to do this, but they have not asked me recently my opinion, so I will keep quiet about it.
I was going to say, do you have to take a class on this stuff? Probably 4.
Yeah, I'm required to take 80 hours of government-specific continuing education every 2 years. Yeah, I do actually the entire government in-house training at Vicente and Brinker. The government work is very specialized because of what the Gatsby determines is critical for the readers of government financial statements to understand. And so there is a lot of specialty that goes into being a government auditor.
Well, we appreciate you and your team, Kellen. Thanks.
Thank you. I have more comments along this on a new slide coming up, but we'll continue with the deferred inflows. So again, you have about 700,000 of deferred inflow related to the pension, 1.8 million related to OPEB. Now, these get even more complicated trying to understand what represents these, and it's timing, and I mentioned this earlier, it's timing differences between the plan investments that were calculated and assumed in previous periods versus how those actual investments have gone up or down in the current period, the current measurement period, and other actuarial assumptions, which can be multiple different things. And again, you can see the specific amounts of what go into those deferred inflows within the financial statements back in the footnotes. But if you want to really understand how all of these deferred inflows and outflows are being calculated, I would recommend looking at the Appendix A of the CalPERS report, and I put the page numbers there, and the Foster and Foster OPEB report. Those are the actuarials that the library uses to calculate these amounts. And I am not an expert in those underlying calculations. As an auditor, what we are required to do is make sure that we can read the reports and make sure that we can evaluate the skills, knowledge, and expertise of the folks who are preparing these reports. So in that case, CalPERS and Foster. So those are what we call management specialists. Management is relying upon CalPERS and Foster to do these calculations and provide these underlying accounting information to the library. the library itself is not preparing these calculations. And in that situation, us as auditors, we do not audit the underlying calculations that go into those numbers. What we're required to do is, again, read the reports, make sure that the reports are accurately reflected in the financial statements, and make sure that CalPERS and Foster have the appropriate skills, knowledge, and expertise to be providing these reports to the library. And if that sounds a little bit like a cop-out, I think it is. But I think that just shows the nature of how complex these underlying transactions are, and the unpredictability of trying to calculate these actuarially determined amounts that are based off of 20 years in the future, what they expect to take place as far as investments and retirements and benefit usages. So they give us auditors a little bit of leeway that they don't ask us to audit those underlying transactions, because a lot of that is based off of calculations that aren't really provable or testable. It's CalPERS and Foster's best estimate of a lot of underlying transactions that are going to take place in the future.
So Kellen, I'm just going to remind the committee that if we have questions specific to the pension plan or OPEB, they would not go to you, but rather to CalPERS and Foster.
Yeah, that's correct. If you want to understand what procedures we performed or how that information gets from those reports into the financial statements, I'm happy to talk about that. If you want to understand the difference between projected and actual earnings in the plan investments over the past 10 years, I'm not going to be able to give you any information for that other than to point to you where that information is shown in the applicable reports.
Okay, thank you.
Next slide, please. So this was another slide I added this year at Andy's request, going back to my previous comment about how unique government auditing is. And as you all know, since you've been looking at these financials for multiple years, governments have a unique situation where their financial information is presented almost in two different sets of financial statements within one report. You have your statement of net position, and then you also have a more unique fund financial statements. So you have both of those presented in this report. And Andy wanted me to talk about the difference and why there is a difference, and kind of what that reconciliation looks like. So the statement of net position is what we consider to be full accrual accounting. Full accrual accounting is what basis of accounting for-profit entities use. It's really the business model of accounting. And what that means is that full accrual means that we need to record all transactions that relate to the time period that we're auditing in that current period. So you're accruing for liabilities, or you're accruing for revenue transactions, and you're not using something called like a cash basis, where you only look at the transaction when the cash happens. So full accrual accounting is what I like to think of as normal accounting requirements. Then the GASB said, we want the readers of government financial statements to better be able to evaluate what resources the government has to spend within the next 12 months. And so we are going to create this other set of financial documents that only show that information. And that is where we come up with fund financial statements, which is the governmental funds balance sheet. And that is reported on what's called the modified accrual method of accounting. So it's not exactly a cash basis, but it's not exactly a full accrual basis of accounting. And I'm sorry if this is a little wonky and a little boring. I'm trying my best to make it make sense. But essentially the fund financial statements only show short-term assets and liabilities. It's only showing what resources the government has within the short term, which in accounting world is 12 months or less, what resources the government has at their disposal for that 12-month period. And so that fund financial statement completely excludes long-term assets and liabilities and deferred inflows and outflows. Now, again, I'm injecting my personal opinion. I don't know exactly how useful that information is to readers of the financial statements. I tend to think that long-term assets and liabilities are important to understand the overall health and financial position of a government agency. But again, the GASB has not asked for my opinion ever. Nevertheless, that's what they've asked us to prepare or required us to prepare, and that's how the library reports their financial statements. So you have essentially two balance sheets and two P&L, profit and loss, or statement of revenues and expenses based on these two different methods of accounting. And that all leads to a reconciliation on page 17 and page 19 of the financial statements that literally goes line item by line item and talks about the things that are included on one financial statement that are excluded on the other financial statement to make sure that we can reconcile between the two. So I know, I apologize again, that's a little wonky, but that's the difference and the reason for why there's two different sets of financial information within this report.
So
next.
I had asked Kellen to review this because I had a feeling that questions would come up about why do we have these two statements and why is there a difference between them? So I hope that was helpful. Do you have any members of the committee with questions for him on this? Okay, Kellen, thank you.
All right, I appreciate you guys are being good sports. I appreciate it. Next slide. So back in the previous slide, I said the Measure Y compliance was about 15% of the audit. The Measure Y fund does provide a large amount of funding to the library, so it's a very important piece to the library financial statements as a whole. And I know that this has come up in past Measure Y meetings, and so I like to include this for all bodies that I report to. But just to talk about, again, what the responsibilities of the audit are versus management. So we do test compliance of Measure Y expenses extensively. It's a big piece of the audit. However, we do not make judgments about the appropriate allocation of expenses between the Measure Y and the general fund. Our position is, and it's how we are required to look at the financial statements, is if it's an expenditure that's allowable under the Measure Y ballot, and in accordance with the Restoration and Enhancement Act that really governs how those Measure Y funds have to be used, if it's allowable, that's what we're determining. We're looking at it from a simple black and white. Is this expense allowable per the laws or the rules? We make no calculation of whether or not the appropriate amount of expenses are recorded in the Measure Y fund versus the general fund when it could be recorded as either one. That is strictly a management decision and a decision for the commission and is not part of the audit. So again, I know that that's more applicable to the Measure Y committee, but I think it's important for everybody to understand what the auditor's role is when it comes to Measure Y compliance.
Kellen, we have a question from Dave Cahill.
Yeah, just a typo here that may be useful to correct because this is your standard presentation. In the next to the last line of the first ballot, the first bullet point, you've got ordinance. It should be ordinance with an I after the D and in front of the N. Ordinance. Ordinance, as you've got it, means ammunition. So there you go. Okay?
I greatly appreciate that, and my apologies. I think that's probably been like that for a few years, and I had not caught it. So thank you for pointing that out to me.
We got a
Quite
sharp,
welcome.
sharp group here, Kellen. I have a question. Under Myrna's leadership over the last couple of years, we have adopted a policy of how expenses are allocated between property tax and sales tax. And I'm going to just kind of review this high level that administrative, tell me if I got this right, Myrna. Administrative expenses are 90% property tax, 10% sales tax. Capital expenses are 90% sales tax, 10% property tax, and general operating expenses, salaries, services, supplies, 60% property taxes and 40% sales tax. What I'm assuming from what you said is, as part of the audit, you're not making any judgment about whether those percentages are good or bad, but you are looking at, did we in fact allocate the expenses accordingly? Am I understanding that correctly?
Yes, to the first part. When we test the Measure Y expenses, we're looking at it from an individual transaction basis. And so we are not looking at the overall whole picture of how the expenses are being allocated, because again, we view that as really a management decision. So essentially that's kind of your current position of how you want to allocate those, but that's not based in the ordinance or in the balance, excuse me, not balance ballot. And so we're not looking at that because there's no penalty, there's no outside penalty if you were to not provide, not to go in that specific allocation. So we're really looking at this from the perspective of, are you following the letter of the law, and not from the perspective of, are you following your own internal policies?
Okay, thanks for that clarification. And I just want to let the committee know that a representative from Pacenti and Brinker will be sharing the audit with the Measure Y committee on November 30th. Yeah, thank you.
Okay. The next slide just talks a little bit about what procedures we actually do, look at, and specifics about the Measure Y. So below the second bullet point, those are all the different things that the Measure Y funds can be used for. And as you can see, it's a larger, or rather large list of things that the Measure Y funds can be used for. To improve the access to the libraries, that can be that's a wide umbrella that can be used to capture all sorts of expenses. Supporting library programs, again, that's a broad definition. And from my understanding of when this ballot was first brought to the public, that was really the point behind the Measure Y. The measure was to have a broad scale funding source to basically expand the library. So the definition of what is allowable under that ballot is rather large. So again, when we do this testing, we're looking to make sure that these expenses are for the benefit of the library under one of these categories, and are not expenses or expenditures that are, I don't want to say frivolous, because that has some judgment to it, but are clearly not related to library operations. So that's really what we're looking for. So it's a pretty large definition. We're really looking for something that, if a member of the public knew that an expense was being made for that purpose, that they might, could reasonably argue that that is not the point of the Measure Y ballot. So it's a pretty wide berth of expenses that qualify. So we're really looking for something that would be outside the norms of what should be recorded there. And again, yeah, back to your point, really, we view that as management's decision of what percentage of, you know, administrative expenses to include in Measure Y versus not to. Our point is that if 100% of those administrative expenses are to support library programs or improve the access to the libraries, then strictly from a Measure Y compliance standpoint, all of those expenses would be allowable. So I hope that does clarify what we're testing.
Yes, thank you.
Next slide, please. So in conclusion, we are at the end of the audit. We're basically just waiting for the approval from this committee and any grammatical or changes to the preference in certain wording that has taken place in past meetings to issue the financial statements. But essentially, we are done with the audit. We did not have any findings. There were no materials of non-compliance. And most importantly, there were no instances of material weaknesses in internal control. And for those committee members that have been part of this committee for more than a couple of years, you will recall that we had a number of audits in a row where we did have control issues that we documented and informed the committee on, which led to those aforementioned long delays in completing the audit. As you can see, we are completing the audit on time, and we did not have any instances of internal control deficiencies. And so I think that's very important to communicate to the Finance Committee and the Commission that from our perspective of what we're required to report, you've definitely improved dramatically over the last few years on your system of internal controls.
Well,
Next slide.
you're seeing applause here in the room, Kellen. Before we get into specific comments or feedback, any general questions or comments about the summary that Kellen has just provided? Dave.
So this is the long hoped for clean audit, which I think is great. And I think we had some pretty rough times 2 or 3 years ago. And thankfully, the county was included in the reporting entity. They helped us a lot, but now we're doing most of this stuff on our own. So I'm very pleased.
Great.
And,
Barbara, Deborah?
oh,
More salutes. That's good.
Does anybody have, so I had met with Kellen and Alyssa from his firm and Jennifer Murphy and Myrna and Erica last week. And Kellen, I had noted a couple of things that you were going to change, but I didn't. Did the committee get the same draft that I had received? So those changes have not been reflected yet.
correct.
Okay. So
Page by page comments.
yes. Okay. So we have to go through the page by page comment. I'd like to take it by sections if we could, and just start with the summary letter, pages 1 through 3. Any comments or corrections on that?
And Chair Elkin, there is one more slide. I don't know if Kellen wants to talk to this
Oh, I'm
last
sorry.
slide.
Yeah, sure. I just one last quick one. These are
Yeah.
required by professional standards that I communicate to you that we did not encounter any fraud, illegal acts, or unusual accounting transactions. I always like to remind this committee that had we found any of these things, that you would be hearing about them prior to this meeting. But again, professional standards require that we communicate this to you. So I want to make sure we include this on the slide, and that is the last slide of the presentation.
Great. Well, thank you. And Lisa, thanks for catching that. Any comments on pages 1 through 3? Okay. The next section, which is pages 4 through 13, is really the responsibility of management. And so accordingly, Vicente and Brinker does not issue an opinion on these pages. Do you have any comments or corrections that you'd like to note here? Barbara,
Now, since we are discussing the whole thing, right, even though this would be directed at staff. The management report, I just wanted to make a comment on, their page 4 or page 11, whichever we're looking at here. Under library program achievements, in terms of kind of the enormity of what we're trying to express, I felt that, we could do a stronger statement than other. The third one down is 41 attendees attending a program. Anyway, I just thought this could be enhanced by some description of our summer reading program, the outreach on the bibliobus, some of the bigger, broader programs that we do. That's just a suggestion to staff in terms of listing this a report again to the public, so they can understand, you know, kind of the bigger things that we do.
okay. Dare I see you and Erica, I mean, you and Myrna taking notes at this point. Okay. Yeah, thank you. Anything else in this section, Barbara?
Yeah, on this section, this would be to Kellen. I was wondering, under financial highlights, that at the top there, it's really a duplication of statement, and I'm wondering why it's necessary to do that. The third line down is about, the third paragraph down is about the unassigned fund balance available for spending at the library's discretion. Then the very next section states the same thing, the unassigned fund balance, what it was. Is there a reason that you spell that out 2 times?
Yeah, again, this is, as Andy pointed out, is really management's product, and is can really be presented in a number of different ways. Working with the county on a number of other engagements, this is their preferred method of presentation. However, you have a large latitude of how you want to present this information. There are certain things that are required to be included here, which is discussion of significant changes from year to year, as well as discussion of future economic activities. But other than that, you have a very, very wide range of options of how you present this information. There is quite a bit of duplication in this MD&A. That's kind of par for the course for government entities, even though it's not necessarily required. And so again, as the auditor, I'm only looking for things that are blatantly incorrect or wrong, and not so much on the exact format or content. So if you wanted to make significant changes to what's presented or the order of what's presented, you have that leeway to do so. And that's not really within the purview of the audit to say yay or nay.
Okay, I'll just toss that over to staff then for maybe consideration of those,
Well,
that duplication.
I guess my techie view of this is that I do see a difference. The first, the first bullet is the combination of the fund balances, right? $45 million. It's both the 2 major funds, property tax and sales tax. And it explains that there was an increase over the prior year, and 25% is the unassigned available, it's uncommitted available fund balance. And in the second sentence bullet, it says that it just further clarifies that 11.2 million is the general fund, and it compares it percentage of the total general fund expenditures. So there is some additional information, and there is a duplication of, you know, addressing the $11.2 million of available general fund balance, but it provides different information.
Yeah, I would agree with that. Other comments on, I'll just make a note that I made a comment on page 12, the last bullet with regard to addressing the unfunded liability related to OPEB. I felt it was important to restate what our commitment was to make additional payments over the years ahead, and that's going to be added here.
What page?
The bottom, page 12, the last bullet. That was something we had talked about during our call.
Another, I'll wait for you all. I did have some comments. Or one. One thing that we're spending quite a bit of time on as a library, and it is a major fund, is our sales tax receipts. And although it's not a part of this audit, I think in management, sometimes you can include information of items that are of importance to the library. And we did not mention, clearly in the management section that Measure Y will be expiring, in a couple of years. So that will be something that the library, I would add a sentence or a bullet point in here saying that this is something that the library needs to be cognizant and plan accordingly.
Right, I think it's just important to add that it will expire unless renewed by voters. Yeah. Any other comments on this initial section, Barbara?
I think it's the same section. How many pages are you?
We're well through page 13 of the report. At the top, it says that this is what Kellen referred to as MD&A, management's discussion and analysis. So it goes through page 13 of the audit. You're good. Okay.
And I'm sorry, Andy, and I hate to interrupt, but I would there's a number of items that are being discussed and good points that are being made, and it's a little bit challenging for me to know exactly what the final conclusions are of what you want to include or not to include, or how you want to include those things. So I would ask that this committee please funnel those comments and changes to the management of the library, so to Myrna, and have her communicate that to Jennifer. And we'll definitely give our blessing on it from an audit perspective. But it's very, very challenging for me to be trying to make notes of all these comments and discussions that are taking place, and to then communicate that over to Jennifer.
Yeah, understood, Kellen. And I think we were only vague because we expected management to make these changes, not Pacenti and Brinker. But
Thank
we
you.
will definitely be more specific on the upcoming sections where you guys were more responsible.
Thank you.
So the next section that I'd like to look at are the fund financial statements, which is basically pages 16 to 19. Any questions or concerns that you would like Pacenti and Brinker to address? Kellen did speak to some of the issues here that I thought were potentially confusing, and I thought did a good job of clarifying. All right, then there's a long section, which is notes to the basic financial statements, and these are notes A through N. Let's just take them one at a time. Any comments on note A? Barbara?
Yes, in the first paragraph, it says that to provide library services on an equal basis throughout the county, and that's always kind of a tricky word, and I'm not sure if it's equal or equitable, but just throwing that out there. We have kind of talked about that before. Obviously, we have different sized libraries and things like that.
Andy,
Dave?
the JPA says equitable
The JP, okay, so
instead of equal,
Kellen, we're looking at note A, the third line, where it says cities in 1975 to provide library services on an, it currently says equal, it should be changed to equitable, which is the actual word in the JPA, please.
Okay, and again, I'm making the notes as we go, but again, Jennifer is the one who is preparing these, and so really all of these comments, even through the notes, should be going directly to her from you guys.
Understood, and I'm Lisa Davison, who's our administrative assistant, will be working closely with Myrna to make sure we capture everything and communicate it to Jennifer.
Okay, thank you.
Okay, Barbara?
Yes, so same paragraph, the top paragraph there on note A. This amendment create a separate government entity, and I would like to add there a phrase with additional representation on the governing board, comma, and cease the library treatment as a component unit of the county, because that was actually one of the critical reasons that the JPA was revised, was to add the additional representation. If you'd like me to repeat that.
Yeah, can you repeat that?
Yeah, this, what it says is this amendment created a separate government entity, comma, and then I would add, with additional representation on the governing board, comma.
Kellen, we're capturing that here and we'll communicate it.
Thank you.
Okay.
That's it for note A.
Anything else on note A? Note B. This is pages 21 through 20. Well, it goes on quite a bit. And includes the discussion of deferred inflows and outflows. This goes up through page 30. Anything on note B? Okay, note C is just one paragraph on page 30. Okay, not hearing anything. Note D, cash and investments. This is pages 31 through 33. Note E, capital assets. Yes, Barbara.
At the bottom of the page, 34 there, it talks about disposition of furnishings and equipment reduced by $390,000 due to disposals and vehicles due to disposals. Does that mean we got rid of old furniture basically to the tune of $390,000?
We did, we released a vehicle and then furnishing. We do that on a regular basis, but let me see the call when we with.
But it just seems like a really large number. Should we say what happens to these furnishings and equipment? I mean, I know that we must have sold the vehicle and got $18,000 back, but that's a lot of furniture. What do we do? Donate that or?
No,
I know it's not a Kellen thing, other than, again, we're trying to reach the public with.
Sure, I'm
information.
sorry, I just wanted to point out that the 18,000 and the 390,000, that was the original acquisition cost. Those items were what we consider to be
Okay.
fully depreciated. as if
Appreciated.
they had been,
Okay,
yeah, fully, so that's not the amount that you you received for them, that's the amount of depreciation. And so you can see in the table above, the actual net carrying value to the library was 0 because they were fully depreciated.
okay. No, I would still ask the question. That's good to know. Ask the question what we do with them. I mean, sometime report back to us, let us know what happens to the furnishings. It's,
We can do that.
okay, thank you.
Okay, now notes F and G relate to the pension plan and to OPEB. And again, I want to reiterate what Kellen stressed earlier, that Vicente and Brinker is reviewing and reporting on information that was prepared by the actuaries. Specific questions can't really be directed to them, but were there any corrections, typos that you saw here that you wanted to call out?
Where are we? F?
Notes F and G.
I had not a typo, but a comment to staff.
Okay,
I'm just wondering if we're due for another valuation on the pension plan. If this kind of applies, the last one was 2 years ago.
Yes, we are.
We're doing one now.
We're doing one this
Great.
fiscal year.
Thank
It'd
you,
be in the spring, right? Yeah, it was on our calendar. Yeah.
thanks.
Okay, note H on page 43, any comments? All right, note I, leases on page 44 and 45. I think during our discussion, Myrna, I had a question about the end date of the headquarters lease, which was recently renegotiated. And I think you were gonna check.
I think it was concluded that it was extended after the period that we're auditing. I think that's what.
Yes, right, okay. So this is correct for the period that was audited, but not,
At the time, as of June 30th, there was no extension.
right,
We were still in negotiations. And the commission approved the extension of the.
right. So Kellen, in a situation like that, where there's been a change afterwards, we just not worry about it here in this report?
It depends on the size and the scope of what the change is. There's some discretion of what can be included. You know, if I would probably not include that one, as it might change the calculations of that disclosure. You could add a subsequent event disclosure to talk about it. But it's probably not what we would say material to the readers to know that it's just being extended for a couple years.
Okay,
But that, again, that would be something that it wouldn't be technically wrong if you included it, so it's at your discretion, but I tend to recommend against putting unnecessary information in the reports.
okay, I'm getting nods here. All right, thank you. And then notes J through N on pages 46 and 47. Any comments or corrections here? No? All right, the next section is required supplementary information, and this is through page 53. These are all financial reports. I'm not seeing any hands going up. We have notes to the required supplementary information on page 54. Okay, and then the final compliance pages on 56 and 57. All right, well, thank you as always to the committee for your close attention to this. Callan, Lisa, and Myrna will work together to get everything over to Jennifer for you, okay?
Thank you so much. I appreciate your understanding of my position on getting those changes communicated. Thank you so much.
Yeah, sure. Any questions for Callan before we let him go? And I know Alyssa's on the call also, and thanks to you for your work on this. Barbara.
This is just kind of a general comment back to the opinion stated on the opening page. I've read this a few times and I didn't quite get the same sense that we got here in the meeting of, you know, there were no material findings, there's no fraud, there's nothing. I mean, it's a nice opinion. It says that everything was presented fairly in all material aspects. Is there a way of like adding an extra strong statement about what a good clean audit it is? I mean, is that appropriate? No.
So you want a cheerleader rather than a CPA?
No, I understand. Unfortunately, no, that is prescribed by the professional standards. It is the least changeable aspect of the report. We have strict guidelines of what can and can't be in there, the order. So I have no flexibility to change it. I totally understand your position, but the auditor's report has to be in a prescribed format that I do not have any sway over.
Myrna?
I would just direct also anyone reading this report to go to the section of compliance, which is page 55. again, that's also very important because that's where any findings would be disclosed. It states here exactly report on compliance and other matters, and it said that there was nothing to disclose. So as dry as it is, that's what
That's
we
as
want.
good as it gets. Yes.
Yes.
Endeavor.
Perhaps the oversight committee will applaud.
Yes, I hope so. Anything else for Kellen? All right, well, thanks, Kellen. Again, really appreciate you and your team at Vicente and Brinker. We're grateful for the job you did on this, and always a pleasure to work with you. Thank you.
It's my pleasure, and thank you everybody for again all the comments and for being good sports with that dry presentation. I know that that's not real fun to sit through, so thank you so much.
Thank you, Kellen.
Thanks, Kellen.
Thank you, Kellen.
All right, bye.
All right, well, I feel like we've already accomplished a lot. We have two other items to cover. We're going to move over to discussion item 4.2, financial reports for October. So Mirna, can you take us through our financial reports, please?
Yes, I will make it short and sweet. You have everything in the written report. So October is 4 months into the fiscal year, and it's 33% of the fiscal year. And so we use that as a marking point as to compare where we are with our revenues and our expenditures to date. And as of October 31st, we've received $3.3 million in revenue total, which is 7.8% of our total revenues. Again, it's very representative of our normal revenue cycle. And what I did want to just point out is sales tax receipts for August were received in October, and it was $1.3 million. And I'm watching this very closely because there's so much attention to the economy right now in terms of whether there's going to be a recession or not going to be a recession. And if it's not going to be a recession, is there a quasi-recession? What I've been hearing is that the job market is still very strong, and markets are strong, and no one is projecting a recession at this time. Is inflation slowing down? Yes, that's a good thing overall. And what do we expect for the holiday season sales? All of this, people are very conservative, not very conservative. They're being modest that things are slowing down. So having said that, I did want to point out that I compared, and I know I made a note in the report that when you compare our October sales tax receipt compared to last year, it is a little less, about $45,000 or 1.7%. So like I said, I'll be closely looking at this and monitoring, and if I feel that there is evidence to make modifications, I would make note of that and present that during our mid-year review. But having said that, anything else that has changed from the prior month? Not much has changed. What I did want to make note of is that this is for the month of October, ending October 31st. And then in November 1st, the commission approved a budget adjustment, increasing appropriations driven mainly by capital, but also to reauthorize funds from the prior year to the current year. And those are not reflected here, but you will see them in the November statements. And also wanted to make a note that the Measure Y Oversight Committee is meeting on November 30th. I will be presenting these reports, And that's where I also will be presenting our allocation policy, meaning looking at the actuals, our actual expenditures and how how we're following our own policy on that. And so I'll be presenting that as well. So that is it in a nutshell, unless you have some questions.
Barbara.
Thank you as always. I did, kind of look at this with the eye to the 33% on the, initial report, that the summary of the sales tax funds. The 28%, we're only, quote, only at 28% on salaries and benefits. Do we still have any significant job openings that unfilled, or we're just running lower than expected for the expenses?
I have not looked at those vacancy lists at this time. We are recruiting currently. And so if this is due, partly it's due to vacancies, but it's also partly due to how closely do we budget benefits? Historically, we have over budgeted in the benefits area, and then at the end of the year, we've had millions of dollars in savings. And so the work that I've done is to better reflect the budget numbers. So there still could be some of that, but in addition to that, the increases to health benefits kick in January. So this number may change a little bit, and but I think you will see the numbers change quite a bit in the next couple of months, getting closer to that 33% or whatever, wherever we are in the year.
Deborah.
Very minor, very minor under the revenues. If I'm assuming that you're going to do the third bullet point, I'm assuming you're going to make it the correct font or the correct size.
Oh, yes. Okay. Thank you.
Barbara.
If we're talking about all the reports.
Yeah, I think we can do that.
Just a quick comment. It's really nice to see this, the each unique payments evening out. I don't know, there for a while, it was kind of bumpy and clumped up and stuff like that, but now it looks pretty consistent at $67,000 or $68,000. So it's nice to see that evening out. Thank you.
We're somewhat climate dependent, aren't we, for that? Yeah. Myrna, I really appreciate the nice summary you did of this, and the explanation for why a couple of items are currently a little bit over 33%. And especially you're drawing our attention to the sales tax revenue. And were there any other anomalies or anything that you wanted to point out specifically to the Finance Committee?
And there were a couple of items that were a little bit over 33%. And it was because of September and October. In September, these items that are prepaid came in, and we paid those. The other is there was a CRC Dynex also came in, and that is, for the full year. So there was a bump in.
Yeah, and please, I apologize. I cannot. What is that payment for? I'm sorry, Darren. Oh, yeah. Okay, thank you. Okay, any other questions on the financial reports? Okay, I think next month they will reflect what the commission approved on November 1st, and we'll have a little clearer picture. Thank you.
The expectation.
All right, then the item 4.3, update on financial forecast of potential sales tax revenue loss. This was something that we had asked Myrna to take a look at, even though we're all cautiously optimistic that the sales tax measure will be renewed. I think we felt it was prudent to begin to assess what the impact would be if it were not. And so, Myrna, I know you've prepared some material on this. I'm going to let you take over here.
Okay.
So the next report is a follow-up to the 5-year forecast that was presented to this committee back in May of this year. And the Finance Committee requested additional information. So this report was created for very preliminary planning purposes after the Finance Committee meeting in May. And the 5-year forecast went through fiscal year 28, which included 2 scenarios. One scenario was the sales tax measure is renewed, and the second scenario where the sales tax is not renewed. And at that time, the Finance Committee requested additional information for the worst case scenario. And but since then, over the summer, the library conducted a community survey of library users and voters. And the overall results showed that there is support for renewing the tax measure. The library is planning to place the renewal for the sales tax measure on the ballot in November 2024. However, it is prudent to plan in the event that the measure is not renewed and anticipate the impact on operations. Next. Go ahead. So here's some background on the sales tax revenue. Sales tax is the second largest source of revenue for the library after property tax. It is 40% of the library's tax revenue. The voters of Sonoma County approved the sales tax measure in 2016. It is at 1/8 of a cent. And it expires on March 31, 2027. By fiscal year 2027, revenue is estimated at $18 million if the voters renew the measure. If the measure does not pass in 2024, the last opportunity to go to the voters is in 2026 before it expires. And in the 2 years in between, the library can make some budget adjustments to expenditures to preserve services and plan for the 2026 ballot measure. Over the last 6 years of collecting sales tax revenue, and the last year, the library received $15.8 million, as you can see in our audit. In total, since 2017, which was a partial year of collection, the library has received over $85 million. And this graph shows the history, and it is in rounded numbers. But as you can see here, it's projected that in 2027, the expected revenue is over $18 million.
Myrna, I'm sorry. And as I'm looking at this chart, the current year now, where we are, July 1 to June 30, July 1, 2023 to June 30, 2024, is that considered fiscal year 2024?
Okay. No, 2024 is down here, and we project $16.5 million this year.
That's for the
The
current year that we're in, which ends in 2024, we call fiscal year 24.
Yes.
Okay, thank you. Okay. So 23 was the year just concluded. I see that we did project an increase, and we're actually seeing a little decrease here, but okay. Thank you.
Yes. So this table is in the written report. The revenue and expenditure projections in the forecast plan presented here are based on assumptions for economic and other conditions, and that they remain the same. The challenge, should the the measure not be renewed in 24 or in 26 is to reduce expenditures to operate within the property tax revenue, which at that time in fiscal year 27, 28 is about $30 million. So I want to caveat that this presentation with the following: any future plan is subject to for reductions is subject to collaboration with the union and approval of the commission. There have been not in so far in the past financial downturns where the library made some decisions. The library adopted furloughs, reduced library hours, among other mitigating actions to protect the workforce. And these potential solutions are always part of negotiations. We do have a labor memorandum of understanding that lays out certain processes. But these are not included in this scenario presented here. So this shows 3 fiscal years where we fully lose the we collect no more sales tax. And the first year that we collect no sales tax is 27, 28. And the deficit at that time is almost $12.5 million. This report provides phased in reductions over the 3 years. And so this is the first year. And in this report, I propose to use fund balance, but fund balance is a one-time source of funding. And we also need to ensure that we currently, the commission has a fund balance policy that must be reviewed also for these extreme cases. Therefore, when we do use the fund balance, it is also a one-time stopgap solution. It's not an ongoing source of funding. So again, we start with $12.5 million deficit. I propose to use $10.4 million. Oh, and at that time, we will have, according to the forecast, $18 million of fund balance available, uncommitted. So we could use $10.4 million to offset the revenue loss, and some reduction also to services and supplies. And this would protect any reductions, any reductions to positions or FTE. In the second year, which would be fiscal year 28-29, after making reductions the first year, the deficit then is $10.4 million. And here I propose to use $7.6 million of fund balance. And that really runs out the fund balance, depletes it. And then you'd still have to make up deficit, proposing to reduce salaries and benefits by $2.8 million, and then reduce services and supplies by an additional $500,000. I have a figure here that shows what the reduction of salaries and benefits is equivalent to FTE. FTE here is 22.84 FTE. And here, this would likely mean closing, but not limited to Sundays. As you know, in the budget, Sunday hours were doable because they were paid 100% by a Measure Y. And on top of that, there's an additional cut of $500,000 to services and supplies. By the third year of cuts, we would be within the $30 million property tax revenue. It's a major cut of $7.6 million that here I propose to reduce salaries and benefits, which are the most expensive, biggest part of our budget. And that is equivalent to 76.47 FTE. And again, this is a reminder that this is only one solution. It is subject to negotiations, any plan. But in the end, under this scenario, it means that we would lose approximately 100 FTE. And that means more than 100 positions because some positions are part-time. And in summary, these expenditures include the reduction of 93.31 FTE. That would be a reduction of our current FTE by 43% or over 230 FTE. It also is a reduction in services to the community, including programs, books and materials, technology, Wi-Fi, library hours, and more, to the tune of $2.6 million. It is elimination practically all of capital projects such as branch refreshes. It also eliminates the contingency fund that we created for this fiscal year, and I had that would be gone. And any impact to the new regional Roseland Library is unknown at this time. So in all of this, we need to keep in mind our strategic priorities. I know that this, looking at the worst case scenario, is devastating, but this is a planning exercise. And however, we remain hopeful that the voters will approve a renewal so that the library can continue the strong critical services that make vibrant communities. With that, take any questions.
Barbara.
Thank you. Yes, not good news. My question is, this is a very useful document to show to the public about the impact of not supporting a tax measure, and helps us think about, just pretty much what we would expect would happen. However, how does this, and I guess it's not however, how does this help us think about when we get the capital improvement plan that's going to come up that we just authorized the payment for? How does this help us? Because it's definitely contingent on using all of the unfunded, the uncommitted tax fund balance to pay for these expenses to supplement our operating expenses for a couple of years until it runs out. How can we think about making plans for the next refreshes, for example? How can we coordinate our thinking about this with thinking about planning for capital improvements? This relies on us having all the money there. Well, then how can we think about spending it for the other refreshes if we're just going to hold on tight to this until we see if the tax measure passes?
Well, currently we're still working within the Measure Y ordinance, and in the Measure Y ordinance, we are obligated to spend the funds according to that expenditure plan. So a big part of that expenditure plan is for capital projects. So I would say that the energy for the library and what we've already done as management is to prepare not only the library and the operations, but also our patrons and our communities, what the impact, how the sales tax benefits their communities, and put our energy in there. I believe that we cannot halt our operations at this time, given ongoing obligations. We're still obligated to meet those obligations.
Right, that's actually separate funding, though. I mean, all the capital improvements we're currently have in the pipeline, they're all accounted for. And the uncommitted fund balance is separate from that, but, right? No?
No,
Well, I'm sorry, so when you were projecting what the fund balance would be at 20, 26, 27, what was the assumption about capital expenses between now and then? So for the current year, for instance, I know we just approved some additional money or released money.
mhm.
We have a couple of projects that are underway. I'm assuming that those are gonna continue at the unfortunate slow pace that they've been at. But there will be some capital funds expended between now and
Yes.
November.
So currently, given new information that we received, right, the forecast was completed earlier this calendar year. And in November or the end of October, we received information that we got all these capital grant funding from the state, and which is great news. And we also know that we have capital projects in addition to those that the library plans to fund. So at that time, I believe we used, after 2024, we used about a $3 million capital budget, because that was our average spend. If we averaged out the last 5 years, we've been averaging about $3 million in expenditures. So that was absent any capital plan. Now that when we have a capital plan, this will have to dovetail. So at this time, we don't know exactly what these projects are going to cost, given the grants that we received. The grants were not fully funded. So currently the library is working with our JPA partners to look at whether the scope of those projects are going to change and how that affects the library's contribution to those projects. So there are a lot of moving pieces. But having said that, currently we have some committed funds for capital, but it's not to the extent of the whole universe of our capital projects. What I expect to happen with these grants, because they will require a letter of understanding between the library and our JPA partners, is that there will be a commitment, a financial commitment on behalf of the library. And at that time, we will be committing funds from the fund balance.
So let me ask this, and I'm not trying to hijack your question here, but to drill in on it. This is just a planning exercise. I get that. And I think if I understand Barbara's question, because I sort of have the same question, I'm just trying to clarify some of the assumptions that went into the financial scenario. So I guess let's assume worst case, November 2024 comes and the voters do not vote to renew. Now, we know we have another shot in 2026. My question is, for the purpose of this exercise, did you assume that if that happened in 2024, that we would stop capital spending at that point, or would some capital spending continue until 2026? In this scenario?
Right, in this scenario, we could, there is a hard stop date for any further capital projects, and I'm trying to bring that up here. Fiscal year 25-20. So the forecast spends $7.7 million in the current fiscal year. In next fiscal year, 24-25, it is assumed $6 million because that we've been planning capital projects. It drops down to 700,000 in fiscal year 25-26. And then it drops down to 0 in 26-27 and in 2027 and 27-28. This is based, I'm speaking from scenario 2 that we discussed. Back in
Oh, okay,
May.
we don't have that
No.
information here. Okay,
Yeah, we're.
all right.
seeing it
So,
before.
so I'm gonna just play that back. So for the purpose of this planning exercise, we're figuring that this year's capital projects will proceed as planned, and that next year there will be an additional $6 million.
Mhm.
But if the measure renewal is not passed, capital projects for the purpose of this planning exercise would stop.
And that still leaves you 18 million. It's the
Still,
18
and that's
million.
where the 18
The
million.
18 million already accounts for the 7.7 this year, the $6 million next fiscal year, 700,000 for fiscal year 25-26, but then nothing for 26-27 because
Right.
we've run
Okay.
out of opportunities.
So I'm gonna take this out of numbers, and I'm glad Ray's here in the meeting because we're gonna need his expert ability to communicate this in words. I'm gonna take a crack at it. Right now, our priority and our efforts are all focused on renewing the sales tax measure. To do that, we need to provide services to our patrons, and we need to be proceeding with capital projects, things that they can see we're making improvement. We have to be doing that. And this plan assumes that we are. In the unfortunate situation that we don't pass the measure in 2024, and we're still going to take another shot in 2026, we have to focus on preserving those assets that are most important to the library, and that's the staff. So we're going to cut those things that are easiest to cut. And the first thing that we would cut would be capital projects. We would make some reduction in services and supplies. And at that point, we reluctantly have to begin cutting staff. But that's the last thing that we want to do. Am I verbalizing what you've articulated in numbers here? Okay. Deborah.
So for the services and supplies, what percentage of services and supplies would that 2 million be? Enough so that, I mean, people will notice that those services and supplies are not there.
Yeah, I
Mhm.
agree.
I hope.
Well, we can look at the current budget year, right? We have services and supplies, $13.7 million.
That I
Yeah.
actually didn't race back up there. Thank you, Andy.
Yeah.
So,
So I appreciate the fact that certainly some of these, we are committed. We have an MOU with the union, so there are processes we would have to follow if we were in the unfortunate position of needing to reduce staff. We have some leases in effect that we would not necessarily be able to get out of immediately. I think it's a sobering picture, but I also think it's important to reaffirm our commitment to staff and let them know that we will do everything we can to support them as the most important asset the library has. Is that kind of a verbal representation of this, of the numbers here, Myrna?
Yes, that is exactly what this proposal is doing. One, it's, the cuts are phased in over 3 years. And, as you can see, it is preserving, support as much as possible. Any, like I said, any plan, this, let's say, the doomsday comes on November 2024, we will be working very hard to look at, you know, a more detailed plan than what was presented today.
Right.
And, but still continue to work to get it renewed in 2026.
Yeah. Dave?
Yeah, with regard to 2026, we can change the process for getting renewal. Right now, everybody's focused on the library placing the renewal on the ballot for this year. That requires a 2/3 vote of the people. If a citizen petition drive places a renewal on the ballot, then you only need 50% of the voters. So if it fails with our method this time, next time we're gonna scrape together a citizens committee and do it the easy way. Because we will never not get majority approval. The difficulty is it's really tough to get 2/3. So we have an easier way to do it in 2026.
So we have options.
Yes.
Yeah. So, did I articulate your question? Okay, Barbara, I'm sorry, I didn't mean to.
You interpreted correctly part of what I was saying. But I was also, and again, as in terms of this exercise, yes. But in terms of a kind of another whole thing out there about, you know, being fair to all the jurisdictions and fixing up all the libraries and so forth that we've talked about before, that feeds into this whole capital improvement plan that we're about to, we've authorized the expenditure of it, and if you're gonna come back to us. Right now, we're planning just to fix up Santa Rosa Central at the tune of $5 million or more. I mean, in terms of committing funds, I understand what you said, but in terms of implementing this big plan about all the other jurisdictions that haven't been, you know, named, or we haven't looked at how much they're gonna cost, it's really hard to, it's kind of like holding two thoughts in your mind at the same time to plan and to tell everybody, yeah, you're in line for such and such a date, but basically we're gonna hold on to the money over here in case taxpayers doesn't pass, because we're gonna need it, you know, to keep things going for a couple of years. Anyway, I just, when we get to the capital improvement plan, I guess we can talk more about it, but.
Yeah, I think what we have to, and I understand what you're saying, but it reminds me of the saying, you can't steal second base while you have one foot on first. You know, we will, as we're doing our capital planning, it's all based on the assumption that we will be able to renew the sales tax measure, and if we're not, then it will be revisited. This feels like a separate exercise that we need to do, but I don't think we can, other than mentioning that that it's dependent on that. I think we just have to proceed with the plan that we've authorized, and let's see what comes back. Deborah?
And I would also say that the request of the finance committee was to come up with a scenario, at least one alternative. And so the larger conversations then are to be had in a different place. So while it always begins in the finance committee, some of these major conversations, we have to have a larger conversation elsewhere.
Yeah, and I do want to say, and Miriam, I really appreciate you doing this, and we had a conversation earlier today. I feel like this is responsive to the requests that we made. I know that at some point back, you and I had talked about a much more detailed planning process. I think we both feel that would not be the best use of anybody's time or effort now. It would require a lot of input and time from management and staff. And I think would be demoralizing if people were looking at that. I mean, this is for our purposes right now. I feel like this is enough, and I appreciate you doing it. Is that?
It is, but
Yeah.
and there's additional, I mean, I think one of the things that we learned during the survey was that the people of Sonoma County are incredibly grateful for the staff of the library. And so it's not just that, it's not just that the commission and management doesn't want to fire anybody or doesn't want to let anybody go. It's everybody understands that the staff are the people who are driving the good feelings and that, you guys are doing the work.
Well, you can't have an empty building,
So,
either.
but we need to keep saying that. That's
Right.
so we can't assume that, people know that the people of Sonoma, that's just one of the things we're always gonna have to say, I think.
No, that's a good point. Okay, well, thank you. Thank you very much for your work on this, Maren. I really appreciate it. Any requests for items to be added to a future meeting? Barbara?
Yes, reading this audit prompted my thinking more about the OPEB policy, which I printed out. And I don't think, what I would appreciate actually is a report next time if possible, laying out how we have met the $3 million. But the confusing thing was that was in chunks of 750,000. And then on top of it, 750,000 each year. And the way we kind of lump it together, the pay as you go with, I'm assuming the 750,000 annually, if we could have a report, maybe just breaking out how we've met this policy every year and what pay as you go is, so we could align those two things with what we say in the audit.
So can we review the OPEB policy and what's happened and what's projected to happen over the next few years without, we're not looking for another report from Foster and Foster, but
I just want to see, like, these deposits, the dates that they were made, that was confusion over time and so forth, and just to see it year by year just would be very helpful.
How much the library has contributed since that policy?
since we passed this latest
Yeah,
policy.
but broken out into the 3 million kind of prepaid chunk that we paid in different chunks, and then the 750,000 annually that's supposed to be coming out of our operating expenses since, I guess, 2018.
So I think, and I have not looked at this, but I believe that our payments could sort of be broken into three categories. So there's a commitment of $3 million. There's a $750,000 annual payment that we're making for the next X number of years. And there's the pay-as-you-go amount, which we're also paying. I believe that's the case, but could you take a look at that and clarify that for us? Yeah. Thank you. Anything else? All right, our next meeting will be Monday, December 18th. I want to thank the committee and staff. This was a really important meeting. I feel really good about the audit report and heading into the new year in a solid financial position. So, Myrna, thank you very much. Garrett, thanks for filling in for Erica. Catherine, thank you for joining the team. And Lisa, thank you for everything.
All the other stuff.
We'll adjourn at 4:50. Thank you.